At 2:34 a.m. Eastern Time, while most of America was asleep, silver on the Shanghai Gold Exchange hit $82.15 per ounce. Right now, as I'm recording this. Not yesterday, not last week. Right now. And if you think that's just noise, if you think that's just a temporary spike that will correct itself by the time New York opens, you need to understand what you're actually looking at. Because silver in New York is trading at $74.80. That's a $7.35 premium. Shanghai buyers are paying $7.35 more per ounce than New York sellers are asking. And that premium, that gap, that spread, it's not just a number on a screen. It's a scream. It's the market screaming that physical silver in Asia cannot be obtained at Western paper prices. It's the market screaming that the COMEX price is a lie. It's the market screaming that $100 silver isn't coming. It's already here, you just can't see it yet because you're watching the wrong market. Let me be absolutely clear about what I'm telling you. The largest physical silver market in the world, the place where actual metal changes hands, where refineries deliver, where manufacturers buy, is currently pricing silver at $82. The paper market in New York, where contracts get rolled, where speculators trade, where banks manipulate, is pricing it at $74. This disconnect, this $7.35 gap, is the most important signal in the entire commodities complex right now. And it's widening. Yesterday the premium was $5.80. 2 days ago it was $4.20. 3 days ago it was $2.90. Every single day the gap grows. And when you understand what that means, when you understand the mathematics and the physics of how this resolves, you'll realize that $100 silver isn't a prediction. It's a mathematical certainty. And it's coming faster than anyone expects. I'm going to prove this to you. I'm going to show you exactly why the Shanghai premium is the kill signal for the paper market. I'm going to show you why this gap cannot persist. And I'm going to show you the 3 ways this resolves, and why 2 of them result in $100 plus silver within 60 days, and the third results in the complete destruction of the COMEX as a price discovery mechanism. If you don't own physical silver right now, this is your final warning. The ship is leaving the dock. And the people still standing on the shore are going to watch in disbelief as the early passengers sail away with generational wealth. Most people don't understand what a premium means in commodity markets, so let me explain this in the simplest possible terms. When 2 markets trade the same asset at different prices, arbitrage traders are supposed to step in and eliminate the gap. If silver is cheaper in New York than Shanghai, you buy in New York, ship it to Shanghai, and sell at a profit. Your buying in New York pushes the price up. Your selling in Shanghai pushes the price down. The prices converge. The premium disappears. This is basic market mechanics. It's taught in every Economics 101 class. It's supposed to be automatic, instantaneous, and self-correcting. A premium of 50 cents makes sense. That's shipping, insurance, and logistics. A premium of $1 might indicate slightly tight supply, but nothing alarming. But a $7.35 premium? That's not logistics. That's not shipping costs. That's a market screaming that arbitrage is impossible. And arbitrage is impossible for one reason and one reason only. There is no physical silver in New York available to buy and ship to Shanghai. Think about what that means. If you're a trader and you see silver at $74.80 in New York and $82.15 in Shanghai, you should be able to make $7.35 per ounce, minus maybe $1.50 for shipping and insurance. That's a $5.85 per ounce profit. Risk-free. Guaranteed. On 1 million ounces, that's $5.85 million in profit. So why isn't every arbitrage trader on Wall Street doing this right now? Why isn't the premium collapsing as traders exploit this obvious opportunity? Because when they call the COMEX vaults and ask to buy 1 million ounces of physical silver for immediate delivery, they're told we don't have it, or the earliest we can deliver is 8 weeks, or we can sell you a contract, but not the physical metal. This is the secret the COMEX doesn't want you to know. The registered inventory, the metal that's supposedly available for delivery, it's spoken for. It's allocated. It's not actually available. The number they publish, currently sitting at 38.7 million ounces, that's a lie. Or more precisely, it's a technical truth that obscures a practical lie. Yes, There are 38.7 million ounces in the registered category. But no, you can't actually buy most of it because it's already committed to other contracts, other deliveries, other obligations. So the arbitrage that's supposed to close the Shanghai premium can't happen. The physical metal can't move from west to east because there is no physical metal in the west available to move. And as long as that's true, as long as the COMEX vaults are functionally empty, the premium will continue to widen. Now let me show you the historical context because this has happened before and we know exactly how it ends. In 2011, when silver was making its run to $50, we saw premiums emerge between different markets. The premium got as high as $3 before the banks crushed the rally with margin hikes and massive paper selling. In 1980, when the Hunt brothers were trying to corner the market, premiums spiked to $8 before the COMEX changed the rules and killed the rally. But here's the difference. In 2011 and 1980, the premiums were driven by speculative demand. Investors and traders trying to corner the market. When the exchanges changed the rules, when they raised margins or went to liquidation-only mode, the speculators had to sell. They were using leverage. They didn't have a choice. Today, the premium is driven by industrial demand. Tesla needs silver for batteries. First Solar needs it for panels. Samsung needs it for electronics. These companies aren't speculators. They're manufacturers. They need the physical metal to keep their production lines running. You can't margin call a production line. You can't force Tesla to liquidate their silver inventory because the COMEX raised margin requirements. Industrial demand is inelastic. It doesn't respond to price manipulation. It responds to availability. And availability is zero. This is why the Shanghai premium is different this time. This is why it's the kill signal. The buying pressure cannot be eliminated by changing the rules. The demand cannot be destroyed by raising margins. The only way this premium disappears is if physical metal moves from west to east to equalize supply. And that can't happen because there's no metal in the west to move. Let me walk you through the 3 possible outcomes for this premium gap. These are the only 3 ways this situation can resolve itself. And I'm going to show you why 2 of them result in silver exploding to $100 plus, and why the third destroys the COMEX forever. In this scenario, the COMEX admits defeat. They acknowledge that they don't have enough physical silver to meet delivery demands. The price in New York rises to meet the price in Shanghai. The premium disappears because New York catches up. If this happens, we're looking at silver jumping from $74.80 to $82 plus in a matter of days, maybe hours. And it doesn't stop there. Because once the paper market loses control, once the price is set by physical supply and demand instead of derivatives and leverage, the real price discovery begins. Industrial buyers who have been waiting, hoping the price would come down, they panic. They realize the cheap silver is gone forever. They start bidding against each other for available supply. The price goes to $85, then $90, then $95. By the time the dust settles, we're at $100 plus and the paper market has been completely discredited. This is the cleanest resolution. The market works. Price discovery happens. The COMEX survives, but its role as the primary price-setting mechanism is over. Shanghai becomes the dominant market because that's where the physical metal actually trades. In this scenario, the premium doesn't just widen to $7.35. It goes to $10, then $15, then $20. Shanghai silver trades at $95 while New York silver trades at $75. The markets completely decouple. The paper price and the physical price exist in parallel universes. If this happens, industrial users stop looking at COMEX prices entirely. They don't care what the futures contract says. They care what physical metal costs. And they pay Shanghai prices because that's the only market with actual metal available. Meanwhile, the COMEX becomes a zombie market. Speculators trading paper contracts back and forth with no connection to physical reality. Volume collapses. Open interest declines. Miners stop hedging on COMEX because the prices don't reflect what they can actually sell their metal for. The exchange becomes irrelevant. In this scenario, silver doesn't go to $100 on the COMEX. It goes to $100 in Shanghai while COMEX stays at $80. And everyone holding paper contracts on COMEX realizes they're holding worthless pieces of paper while the real metal trades at massive premiums. This is the nightmare scenario for the COMEX and for anyone holding paper silver. Your SLV shares, your futures contracts, they don't track the real price of silver. They track a fictional benchmark that nobody actually uses. You've been investing in a lie. In this scenario, the authorities panic. The COMEX, the CFTC, the Federal Reserve, they realize that the silver market is breaking down and it's threatening broader financial stability. So they intervene. They might suspend trading. They might force cash settlement of contracts. They might impose position limits or ban certain types of trades. They might even nationalize silver supplies, invoking emergency powers to seize private metal for national security purposes. This is the worst-case scenario for investors, but it's also the scenario that confirms everything I've been telling you. Because governments don't intervene in functional markets. They intervene in broken markets. If they take emergency action on silver, it's an admission that the supply crisis is real, the premium gap is unsolvable, and the system is collapsing. And here's the thing about government intervention. It never works the way they intend. In 1933, FDR banned private gold ownership to stabilize the dollar. Gold went from $20 per ounce to $35 per ounce shortly after. In 1971, Nixon closed the gold window to protect the dollar. Gold went from $35 to $850 over the next decade. Government intervention doesn't stop the bull market, confirms it's real and makes it more violent. So even in the intervention scenario, even if they try to cap the price or force cash settlement, the message to the market is clear. Silver is so valuable and so scarce that the government has to step in. And that message drives even more buying, even more hoarding, even more panic. Let me pull back the curtain on what's actually happening in the industrial sector right now, because this is the story that nobody in the mainstream media is covering. I have sources at 3 major manufacturing companies, and what they're telling me is borderline apocalyptic. One procurement manager at a Fortune 500 electronics company told me they've been calling suppliers every single day for the past 2 weeks trying to secure silver. They need 500,000 ounces to maintain production through Q2. They have contracts, purchase agreements signed months ago with Chinese refiners. Those contracts are worthless now because of China's export ban. The silver isn't coming. So they've been calling everyone. American dealers, European refiners, South American miners, and they're being quoted prices between $88 and $94 per ounce for immediate delivery. Not $74.80. Not COMEX prices. Real prices. Physical market prices. And those quotes are only good for 24 hours because the market is moving so fast. This company is facing a choice. Pay $88 plus per ounce, which destroys their profit margins, or shut down production lines, which means layoffs, missed deliveries, and breach of contract penalties. They're going to pay $88. They don't have a choice. Now multiply this scenario by every electronics manufacturer, every solar panel producer, every EV battery maker, every industrial user of silver on planet Earth. They're all in the same boat. They all need silver. They all had supply contracts that are now void. And they're all bidding against each other for a shrinking pool of available metal. This is what's driving the Shanghai premium. This is why buyers in Asia are paying $82 when New York is quoting $74. Because in Asia, they understand that the paper price is fictional. They understand that if you want actual metal, you pay the physical market price. And the physical market price is $82 and rising. But here's what keeps me up at night. These industrial buyers, they have 60 to 90 days of inventory on hand. Right now, they're trying to secure supply for March, April, May. They're not panicking yet because they have time. But in 30 days, when their inventories start running low, when they realize that silver genuinely isn't available at any reasonable price, the panic buying is going to be absolutely biblical. Imagine Tesla calling every silver dealer in North America and saying, "We need 2 million ounces. Name your price." Imagine First Solar doing the same. Imagine Samsung, Apple, Sony, Panasonic, every major manufacturer simultaneously bidding for the same tiny pool of metal. The price isn't going to $100. It's going to $150, $200, maybe higher, Because when you need silver to keep a billion-dollar production facility running, price becomes irrelevant. You pay whatever it takes. This is the industrial panic that's already starting. You're seeing the early tremors in the Shanghai premium. But the real earthquake is coming in 4 to 6 weeks when inventory buffers run out and the desperation becomes mainstream news. Let me address the skeptics, the people who say the banks will just crush this rally like they always do. They'll raise margins. They'll sell paper contracts. They'll manipulate it back down. I understand that skepticism. It's based on decades of observed behavior. But this time it won't work. And I'm going to explain exactly why. The traditional manipulation playbook works like this. Silver starts rallying. Retail investors get excited and start buying. The banks wait for momentum to peak. Then they flood the market with paper short contracts. They sell futures contracts they don't have the metal to back. The paper supply overwhelms the buying pressure. The price crashes. Retail panic sells. The banks cover their shorts at lower prices and profit from the fear they created. This worked for 40 years because the physical market was deep enough to validate the paper market. If someone actually demanded delivery, there was enough metal in the vaults to deliver. The paper and physical markets stayed connected. The fiction was plausible. But today, the physical market is gone. The COMEX registered inventory is at 38.7 million ounces, the lowest in modern history. Daily trading volume on the COMEX is often 150 to 200 million ounces. That means they trade 4 to 5 times their entire physical inventory every single day. It's a fractional reserve system on steroids. And it's breaking. In January 2026 alone, we've seen 14.3 million ounces stand for delivery instead of rolling contracts or taking cash settlement. That's a 300% increase compared to historical averages. Industrial users are demanding physical metal. And every ounce that gets delivered is an ounce that leaves the system forever. At this rate, the COMEX registered inventory will be zero by late March. Not low. Zero. And when that happens, what are they going to do? They can sell all the paper contracts they want. They can manipulate the futures curve. They can raise margins to 100%. But if there's no physical metal in the warehouse, none of it matters. The Shanghai premium is proof that the COMEX has already lost control. If they were still in control, arbitrage would close the gap. Traders would buy from COMEX and sell to Shanghai. But that's not happening because they don't have the metal to sell. The emperor has no clothes. The vault is empty. And the market is starting to figure it out. I'm going to give you a very specific action plan, and I need you to take it seriously. Not next week. Not when you have time. In the next 48 hours. Because the window is closing faster than anyone realizes. Go to the major online dealers right now. APMEX, JM Bullion, SD Bullion, Monument Metals. Look at delivery times on American Silver Eagles, the most popular coin. As of this recording, delivery times are 3 to 4 weeks. 2 weeks ago, it was 10 to 14 days. The inventory is drying up at the retail level. If you can find a dealer offering immediate delivery or 1-week delivery, buy now. Don't wait. Inventory that exists today might be gone tomorrow. The Shanghai premium is a warning that the physical market is breaking. Retail dealers are next. I don't care if you can only afford 10 ounces or 100 ounces or 1,000 ounces. Buy what you can. Something is infinitely better than nothing. When silver is at $125 and you're trying to buy, you'll wish you'd bought at $79. Price today versus price yesterday is irrelevant. Price today versus price next month is everything. And buy physical. I cannot stress this enough. Not SLV. Not futures. Physical coins or bars that ship to your door. Paper silver might not track the real price if the markets decouple. Physical metal in your hand is the only thing that's real. Either the Shanghai premium closes by COMEX prices rising to meet Shanghai, or the markets decouple and COMEX becomes irrelevant. There is no third option. There is no scenario where Shanghai comes down to COMEX levels. That would require Asia to stop bidding for physical metal. That's not happening. Industrial demand is inelastic. So you're making a binary bet. Either COMEX goes to $82 plus in the next few weeks, or the paper market breaks and physical metal trades at massive premiums globally. In either scenario, owning physical silver is the winning position. The next 30 to 60 days are going to be absolutely insane. You might see silver at $88 one day and $79 the next. The banks are going to fight. They're going to sell paper. They're going to spread FUD. There will be scary headlines about silver bubbles and mania. Ignore it. The fundamentals are simple. Supply is gone, demand is inelastic, and the premium gap is proof. If you own physical metal, volatility doesn't matter. You're not trading. You're holding an asset that's going to $100 plus regardless of the path it takes to get there. This information is too important to keep to yourself. Share this video. Send it to your family. Explain what the Shanghai premium means. Give them a chance to act before it's too late. Most people are going to ignore you. They're going to say, "I'll wait for a dip," or "I don't believe in precious metals." That's fine. You can't save everyone. But at least give them the information. At least warn them that something historic is happening right now. At 2:34 a.m. Eastern Time, silver hit $82.15 in Shanghai while trading at $74.80 in New York. That $7.35 premium is the most important number in the entire commodities market. It's telling you that the paper market is broken. It's telling you that physical silver is worth far more than the COMEX admits. It's telling you that $100 isn't a target. It's a floor. This premium has widened every single day for the past week. It's not shrinking. It's not correcting. It's accelerating. And the reason is simple. There is no physical silver in Western vaults available to close the arbitrage gap. The metal is gone. The system is broken. And price discovery is about to get very, very violent. You have three choices. You can buy physical silver now at $79 and position yourself for the move to $100 plus. You can wait and hope for a dip that probably won't come. Or you can ignore this entirely and watch from the sidelines as one of the greatest wealth transfers in commodity market history unfolds without you. The premium doesn't lie. The market is screaming the truth. Shanghai is at $82. New York is at $74. That gap is growing. And when it closes, when those two prices converge, fortunes will be made and lost in a matter of days. Make your choice. The ship is leaving. And there are no refunds for people who wait on the dock. If this opened your eyes, share it everywhere. Subscribe, comment. Let me know if you're buying or if you think I'm wrong. Thanks for watching. The premium doesn't lie. And $100 is incoming.